All right, great. Welcome everybody. Thank you guys so much for joining our resources webinar that we've been conducting in partnership with our sponsors who are truly have been our partners because of everything that's going on. Obviously, entrepreneurs, business owners, folks in the community, love the opportunity to gain any sort of knowledge about navigating the current climate and being able to also connect with professionals and specialists and subject matter experts that can help guide you throughout the way. You guys know the format. We'll do the panel for anyone that's also in the attendee room. If you guys have any questions, you guys should see an icon on the footer of your screen. Please ask your questions there. We want this to be engaging. Also in the chat room, please do ask your questions there as well. With that, I'm going to go ahead and introduce Jagruti, who I've known for about over 5 years, and she specializes in technology and blockchain at Aprio, and the services that she helps out with are obviously tax audit readiness, and consulting services for people or companies that have the technology and blockchain background. One of the great things is that, with working with Jagruti and Aprio for so many years, the opportunities that she provides in terms of connecting entrepreneurs, not only to the resources at Aprio, but also through their global resources that they have as well, which has been really, really awesome. And kudos to Jagruti. 2018, she was also awarded the Innovative Practitioner Award. She really does, do a great job with working with entrepreneurs. First, obviously learning about, what their company does, some of the pieces around it as well, and also giving a lot of great guidance. And not only does she do this for at Aprio, and also supports our organization, but she's very involved within the community, also participates in TAG. She also leads our Thai Women in Business group, and also board member at a lot of other community engagements and foundations as well. So with that, we'll go ahead and get the panel started. Jagruti, if you want to go ahead and kick things off, introduce David, and we'll get to it.
Okay, thank you so much for that awesome introduction.
Jagruti,
happy to be here, and thank you everyone for joining this session. So very quickly, I think one of the things, as we were kind of brainstorming internally, what we thought about was, companies, like we get a lot of clients and questions around cash flow management issues, tax breaks, what are the tax credits that are available to companies, whether they're early stage or mid-size or ready to go IPO or exit, right? So what can companies do today in terms of managing their cash and maximizing any kind of credits that they can take advantage of? And as we're talking about that, I figured, I should probably get the 2 experts that we have at our firm and get them on the panel and hear from the experts what they have been seeing with our clients and with other companies. So with that, I have David Zaft and Charles Webb as our panelist. Quick introduction, David, he's a director in our transaction advisory service group that deals with mergers and acquisition, transaction related activities. He's got a total of 20 plus years experience, including prior Big Four experience. His responsibilities mainly include assisting clients with performing buy side and sell side due diligence, transaction closing assistance, post close integration assistance, synergy realization, capital structure alignment, and all the fun stuff that comes around with transaction related activities. And then Charles Webb, he's a tax partner with Aprio, focusing in technology and international space. He's got over 25 years of experience, which includes his previous entrepreneurial experience where, he was helping early stage companies and mid-sized companies with corporate tax and compliance and strategy. He works closely with early stage companies, kind of walking them through and advising them on what kind of tax benefits companies should be thinking of and not leave money on the table. So between the 2 of them, we are hoping you guys, there are some key takeaways that may help you and your company. And with that, I think, Charles, I'm going to start with you. With the recent COVID situation and the CARES Act that has been quite popular, what are some of the main business tax provision that you are seeing with the CARES Act that you can educate the attendees.
Okay. Thank you, Jacuti, and good afternoon, everyone. Thank you again for having us. So with the CARES Act, there were a lot of things that were added to give stimulus and cash to businesses by filing an amended returns or some changes to tax law. So I'm going to apologize for my industry, but CPAs are busy as all get out, the busiest I've ever been in my career. So this may be a chance for you to reach, you may need to be a little proactive with your CPA or tax advisor to make sure they're pursuing some of these refunds, because again, there's so much that they're so busy trying to do. But one of the biggest things that changed was the ability to take net operating losses for 18, 19, and 2020 and carry them back 5 years. So this one's really big in that in 2018, if by chance you had a loss, you would be able to carry that back to 2014. So if you changed accountants, or maybe your accountant maybe was not aware, has not had time to look back and see if you had profits in 2014, 15, 16, in any of those years, you could take the losses back from amend a return to 2018 and carry it back to those old years and get the government to refund you the tax you paid in those years. It also is going to be for 19, and unfortunately, I think most businesses will have some losses in 2019, but it'll be very important for cash flow to make sure you get that tax return in. If you historically don't get your data to your accountant until March or April, you may want to accelerate that next year, because if you have losses in 19, you'd want to get that tax return filed as soon as possible so you can carry it back and get taxes paid back that you paid from old years. So that was the one big thing to help companies to sort of sort that out, to spread out the profitable years and the loss years. Again, as I mentioned, that's a 5-year carryback. We never had that in history. Previously, we went back 3 years, and in the Tax Act that came out in 2017, they actually eliminated the carryback altogether. That was very controversial, especially in the tech world, where you had, again, maybe profitable years, and maybe as you rolled out another version of your product, you may have had a lost year. So the ability to carry back was huge, and that will continue for 18, 19, and 20. The other thing that was very controversial in the Tax Act in 17 was the limitation on NOLs going forward. So if you had losses from 18, your losses were limited from being carried forward up to 80%. So again, a lot of startups, this was very controversial, because you may have losses and then in the early years, but then you're going to be limited so that everyone was going to have to pay at least 20%. So again, keeping in mind that 80% was how much was limited. So 20% you could not use that NOL. So therefore, small startups were going to be taxable in 19 and causing some surprises. The other thing that many of you may have known, if you've done the PPP loan, you've heard about those and applied for them. But the biggest thing is the ability to to defer your FICA share of your employer tax. So that's the 6.2, and they specifically carved out and said it's the employer portion of the FICA tax, not the employee portion, the 6.2 that was actually deferred. It's the employee portion. And we believe, and from talking to legal, what we believe is, I know a lot of folks are concerned is that what if I don't pay, what if I don't have money to pay those taxes? Can they come after me personally? Well, with payroll taxes, you do have to be very, very careful. That's one thing where the government does not, that they're very aggressive about. If you've withheld taxes, FICA, federal income tax withholding, and you don't pay that in, then they definitely can come after you personally, or anyone that's on the bank account, an officer. So a lot of concern was in this, well, what if someone could come after me? Did the IRS come after me on this? Keep in mind, that's why they said it's the employer side. So it's not the withholding amount. So they technically cannot come after you or the officers because it's not a withholding. It's not the amount withhold. So there was also another clarification is, well, what if I get the PPP loan? If you did get the PPP loan, they came out and clarified that you can defer the employer tax, the FICA tax, the 6.2, all the way until you get your loan forgiven. So let's give an example. Say that you've applied for the loan and you get the loan and the money comes in June 1st. You get the money and you use that PPP loan to pay payroll for June and July. August 1st, you would file an application with your lender, and that form will tell them, what did you use the money? What did you use that money for? And you want to confirm that you used it for payroll. If you sent that in on August 1st, the lender has up to 60 days to look at it and analyze it and then issue a loan forgiveness. So what clarified in some recent guidance from the IRS is that you can defer the payroll taxes all the way until you get your letter. And so if it's August 1st, September 1st, and they give you your letter on September 30th, you can defer your employer FICA tax all the way to that point. So the payroll companies were very slow about putting this in. But now most have caught up and have either sent you an email asking you, or when you go onto the website, there's a special provision that allows you to defer. Key thing to make sure you watch though is the payroll company will make you sign a lot of legal agreements, making sure that if you do defer, it will be your responsibility to pay the payroll tax. And where the deferral is, 50% will be due in December of 2021 and 50% will be due in 2022. In our mind, we think that's a no-brainer unless, again, we think it's just a free loan. If you've got that ability to do that, if you can defer that payroll tax, that's 50% all the way up until 2022, you could do that. That being said, you will have to pay that tax yourself. So an ADP is not gonna, and when that payment is due in December, you'll have to make that payment to the IRS yourself. Again, it's very easy to do. You just register with the federal government program. It's called EFTPS, and I'll be glad to send you one that link to get registered if you do that. But just keep it in mind, that's one thing to be careful of. And the other thing to be careful is, once you get your loan forgiveness on the PPP, so that letter you get on September 30th, it will be your responsibility to contact the payroll company and tell them, I got my loan forgiveness, you've got to stop doing the payroll deferral. So just something to keep in mind, to watch for in that legal, buried in that legal language that the payroll company is going to have you sign, will be that you take responsibility for paying the payroll taxes in December 2021. And then second, you will be responsible for notifying us once you get your loan forgiveness. So just something to keep in mind. But again, we think that's huge, huge for cash flow if you can defer that. There is an employee retention credit that's available, so that if you have employees that actually have COVID, or actually have the virus, then you actually, one of their family members, you can get a special credit applicable to that employee. One of the other things is that they're giving you cash flow is if you've ever paid A&T, alternative minimum tax, on your business, your corporate account. If you've ever paid that, the Tax Act in 17 allowed that to be refunded, but it was refunded over 5 years. So what the CARES Act came in and says, all right, we're going to go ahead. You don't have to wait the 5 years. We're going to let you have that money back now. And so you would file them in return and it'll send it to you. So I mentioned this is that where we found is, say that you've changed accountants, or even your accountant changed softwares. A lot of times they didn't, accountants, when they changed, they didn't focus on the A&T tax, but that carryover, because a lot of times it wasn't applicable. It was really hard to get back. So I caution, if you look back in your years of doing business, if you ever remember doing alternative minimum tax and ever paying that, whether that was 10 years ago, it goes back all the way, is make sure that you do notify your accountant very quickly, make sure that you can get that application in. On both the net operating loss carryback and the AMT carryback, they are doing a special accelerated provision. And if you get that application in by June 30th, you can get that money back. So very important to jump on that and get that process going to get the money back accelerated by June 30th. One other thing I'd like to mention that came out.
Quick question. Sure.
Sure.
So the June 30th deadline is for companies with year in December, right?
That's correct. And the June 30th is for them to file this quick carryback claim to get their NOLs, the money applicable to net operating losses, NOLs, and then also for the AMT. So great. Thanks for that clarification. One other area that also has got potential for refunds. One of the things that was clarified in the CARES Act is if you have leasehold improvements. Leasehold improvements, unfortunately, were, there was a technicality in the law in '87, and leasehold improvements were intended to be at 15 years and subject to bonus depreciation, meaning that you could immediately write off your leasehold improvements. There's a technicality and the language didn't get in the 2017 Act. They finally clarified it in the CARES Act. So if you've had any leasehold improvements starting with 18, then you'd want to look at that because your accountant was required to amortize that over 39 years. Now that accountant can go back and file an amended return and get you, if you had leasehold improvements, can take it as 100% deduction by filing an amended return. So another one for cash flow, if you've got leasehold improvements to take a look at. And again, not just for 2019, it went back to 2018. So you'd want to check your 2018 if you had leasehold improvements to go in and claim that refund. And again, the refund claim would be for the June 30th. You want to make that. You can still do it after June 30th. It's just much more time consuming and the IRS doesn't have to respond to it in 60 days. So again, another important to take a look back at your old returns and consider your leasehold improvements. There's one other area I want to mention to you that also changed is one of the things in the tax law that there was a limitation. The 2017 Act limited your ability for certain corporations to take interest expense. And that was limited to 30% of your taxable income. This was, again, very controversial because the Congress was trying to push folks to invest using equity and not debt. So this was one stick that they had to get you to put in equity and not use the debt. So because the interest was not deductible. The CARES Act changed that and go up to 50%. So if by chance you had that limitation, you can go back and file an amended return for 2018 as well.
Sounds like there's quite a bit of tax breaks with the CARES Act, and we just say the NOL carryback, you got the AMT, the accelerated recovery of AMT that you can look into. You have the deferral of the 80% income tax, income limitation. There's the employer payroll tax deferral that you can take advantage of, the employee retention tax credit. That's a lot of good ways to look into and save some extra dollars during this time. I have a follow-up question for you, Charles, but let me switch to David. David, what you are talking to clients and companies, as you are helping advise them on ways to save cash or maximize your working capital needs, right? And maybe suggesting some ways to cut down certain type of expenses. Obviously, the tax is huge, but what are you seeing, as you are talking to clients?
Sure, great question. And we approach it similar as a diligence assignment, except for the fact that we're not looking at a third-party company that we're looking to purchase. We're looking at our own income statement and balance sheet. in going line item by line item through it and trying to better understand what is driving the activities through that account. We like to put it in a framework of a 13-week model, which, in our mind is a rolling next quarter. And think about what revenue will we be seeing going forward? What expenses are we going to be incurring? And most importantly, not only what expenses are we incurring and revenue are we seeing, but what is the cash ramifications? Are there items where sales may continue, but customers will drag payments out? Are there areas that we can collect outstanding AR that's been on our balance sheet or been in our, collection roster for a while? Are there expenses we're going to incur, but we don't need to pay for? Charles made some great points. Any diligence assignment has a lot of tax ramifications. As you think through different areas that we're seeing a lot of activity and questions on, payroll and payroll taxes. Let's put aside PPP and some of the deferrals that you can have. At a very simplistic level, if you're reverting your payroll taxes on a quarterly basis, can you keep that payment within your cash accounts, not put it through your payroll processor? Charles' example was talking about ADP, and submit that payment yourself on a quarterly basis. Obviously, you need to keep the cash on hand. You need to make certain you have access to it at the appropriate time, but there's definitely some levers there that we've talked to clients about. Same thing on rent. What can be done? Is there any free rent, deferral of rent? A lot of landlords are willing to work with different companies in different situations and provide company specific terms. Those are a couple of the big points that we've talked through with almost every client that we've talked to about cash flow modeling, but it really does begin with a conversation on the income statement and what revenue will we see going forward as we work our way down, what expenses are we going to incur, and then the cadence of those collections or payments.
Okay. There are a few questions that people have, and maybe I'll just jump on and ask some of these. One of the questions is, can we take the NOL carry back against W-2 income back to 2014? I think this is probably more Charles.
You could. It does apply to individuals. Oh, sorry, on mute.
Go ahead, Charles.
There, can we hear me now? There, great. Yes, it does apply to individuals so that you can carry back. So it's both corporate and as well as individuals. There's a special rule for partnerships, but they can be amended in certain partnerships, depending on the type of partnership can. But yes, so that's again great advantage and good point to possibly take that get back against W-2 income.
And the AMT refund applies, you're talking about the AMT refund that applies to individuals and entities, right?
Yes, right. The AMT is only just for corporations. Unfortunately, they did not put that in for individuals, but it's for the corporate AMT.
Okay, AMT just for entities. And those corporations like partnership and C Corp, or just, C Corp and S Corp?
Just the C Corp.
Just the C Corp. Got it. Okay.
That's correct. Just the C Corp.
Another question: is there some kind of relief? Is there some kind of relief for businesses that are significantly down revenue or net profit in 2020, but the business is not necessarily in a loss? So they are kind of profitable in 2020. Profits are down. So any kind of tax relief or any suggestions on that side?
Yeah, nothing specific more than we've got lower tax rates. That helps. If it did result in a loss, we have that ability to carry the loss back. If we're still just breaking even, there's really nothing special as far as in the current year. What we do see on businesses is there may be a way for you to change your method of accounting or to change how you write off and recognize either revenue or some of your deductions. And so we're just beginning to analyze this. In other words, you always can have a different method of accounting for your books or your GAAP books and for tax. So we're really looking at maybe there's a chance that we want to change from accrual to cash basis, or there may be some additional revenue recognition rules that are out there that we can do in a change of accounting method with the IRS that's going to give us a loss in 2020. And then where you think on your books, you may have profitable income, you know, there may be some tax deductions. Depreciation is one of those that if you did have leasehold improvements, you would be able to write off all that 39 property. So there may be the ability to create a tax loss and carry that back.
Interesting. David, anything you want to add there?
Yeah, I
you
mean,
work a lot with companies on revenue recognition and kind of managing that from a tax perspective.
Yeah, I would say putting ourselves in a framework of still being profitable. I don't think that a lot of what we're talking about is just for companies that are unprofitable when we're talking about PPP and some of the deferrals. You know, to be candid, when I'm thinking back at the companies we've done cash flow modeling work for and a lot that we've had conversations with, the vast majority have shown some type of profit, whether it's on a monthly basis, a quarterly, whether it's been a little bit historical, a little bit going forward. Not any one of them was unprofitable historically and was going to be unprofitable going forward for the foreseeable future. So they were trying to find their way there. So when we think of items like we talked about on payroll taxes and either deferring your payment to your payroll provider, somewhat Charles talked about on the PPP, obviously it gets very complex, but you can still take advantage of that. I have not seen a landlord come back. In the one case that we were really in the details with our client, there were 2 locations. Both landlords had given concessions on a combination of lower rent, so let's call it free rent for some periods, in deferral of the rent payments. I don't think the landlord came and said, are you still profitable or was unprofitable? They knew business was down. In this case, revenue was down approximately 75%. I think if you start looking at the details of a P&L, things that we've seen a big cutback on marketing costs. We've also seen it where clients have committed to some type of convention in the next quarter or two. And some of those require down payments of certain costs. A lot of those conventions have been canceled. A lot of those are going online. A lot of those costs payments can come back in some form or another. And we've seen clients somewhat not necessarily jump off the paper, but once you start having those detailed conversations, they start driving to some of those discussions. And I think all of those are applicable if you're profitable. And I would definitely say on the examining your AR and what you can collect in your AP, once again, it's going to be agnostic to the profitability situation. I mean, to be candid, when we're talking to our clients, we say try and collect everything you can and stretch everything that you owe, but everyone's doing that. So it is definitely a balancing act to be played because your customers and your vendors are going to be doing similar types of things. But working with each individually, looking at all on a case-by-case basis and finding the best situation for your given company.
Sure. And I think, with the PPP loans, the forgiveness strategy around that, I think that's another way. I wouldn't say necessarily it is a kind of relief, right? I mean, you're getting an SBA loan and you're using it mainly because your business has been impacted in some shape or form because of COVID. And how do you maximize on those proceeds that you're getting and, kind of be in compliance and see how a good bit of that can be forgiven. I think that's another significant break right there. One more question. So in terms of the leasehold improvement tax break, is that for tenants and landlord both, or is it one of the two?
It is, but it depends upon the lease and issue. If you had the right under the lease to take that leasehold improvement, then, excuse me, if according to the lease and in the lease agreement, if you were the one that technically owned it and were able to depreciate it, it would apply, depending upon if you're either the landlord or the lessor or lessee.
Mm-hmm. And are there any breaks in the CARES Act for landlords who are losing tenants because of the situation? Some sort of where they can provide some sort of free rent to keep tenants, but don't necessarily qualify for PPP. And I guess the second part of that is they probably don't even have employees. So any kind of tax breaks to landlord with no employees and are having to give away rent to keep tenants.
Nothing specific right now. For the landlord side, for the leasing, and David, I may defer to you on this. Is if you're trying to control expenses, is there the potential that the leasee could go back to the landlord and ask
Yeah,
for?
I mean, I definitely think there's a lot of interesting areas you could dive down in here, and we've talked about this with clients and on some industry-specific webinars. I'm reading the question as well, so I'm going to take it one avenue. And Dan, who asked the question, please, pipe in if you'd like us to keep going down that avenue or go a different route. One thing we've seen, if the landlord has debt on their books, is that banks don't want keys being brought to them right now. No one wants to be the first one to say, I'm going to foreclose. Now, we've read about Hertz. You've probably read about J. Crew. You've read about Neiman Marcus. Some of those business models weren't working the best prior to the downturn in COVID. We kind of think of them as almost like a dead on arrival type situation. I'm going to take this particular landlord out of that bucket. What we're seeing is a lot of banks giving forbearance on principal payments. So what I would say is the first step, and the first thing we've talked to clients about, is looking at their bank and saying, what can I defer? As you can see, my tenants I've given free rent to, I've done other things to help them. And we've seen a lot of banks look at the covenants and either look the other way. I think we're still a little bit early into it. I don't think banks have formally come out and said, we're waiving that covenant for this time period, but they've basically done that outside of a legal agreement. They're not foreclosing. They are legally extending payment terms and going interest only on certain loans. So there's ways to think through managing your cash flow on the flip side. Now, you still may be down some. In one thing, we did have a webinar. It was a little bit more towards residential and multi-unit properties. But one thing that we were seeing that they were doing is they were saying, listen, before we paid third-party vendors to do these list of services, as an example, anything related to landscaping, some of their maintenance crew was kind of working kind of half hours. And they said, listen, we got PPP, we're going to keep them on. But one thing they're going to do is we're going to do a little bit more of our own landscaping. When you think about utilities, are there any things you can do? In the multifamily setting, it's a little bit tougher, right? You have units that are spread out. We've talked to some of our more retail-centric tenants. Is now a good time, especially as Charles talks about some of the qualified investment initiatives that can be undertaken. Do you put in sensors on your lights so they turn off at night? Can you do certain things like that? What are we thinking about setting the temperatures in an office? If there's no one coming in, do we really need the AC running on the same set schedule as it was 2 months ago? In those type of activities are somewhat helping mitigate this cash flow. It doesn't fully replace it. But those are at least ideas to get you in a little bit better spot. And we've seen for the most part, those are resonating with the landlords, but especially on the banking side, it's definitely resonating. The banks are not trying to foreclose right now. They're trying to find ways. There's obviously the PPP we've talked about on a bigger scale. There's the Main Street Lending Program. We call it the MSLP. There's a couple facilities under that. It's a little bit more geared towards larger companies. Smallers definitely still qualify for it. But when you think about that, I think, it would not be looked down kindly on the banks with the support coming in from the federal government, the Fed, in this case, and the MSLP, and then foreclosing when they're trying to make these facilities available. So we do see that at least some of these forbearances being put into place.
Interesting. So Charles,
I'd like to go back to the question. Sorry to interrupt. I'd like to go back to the question where you have a lower taxable income. Are there some other things to do? And I was thinking about, there's just some tax credits out there. And so we want to make sure that we're taking advantage of all the tax credits. And probably the biggest one is the research and development tax credit. And and it's key that you think and look, it's not just everyone thinks of lab coats and it has to be a drug or research. It also includes its processes, its development of a process or changes to a process or changes to if you are developing software. And the key is also to think about thinking outside the box. And it's not just the developers. A lot of times when you're in startup mode, everyone in the organization is involved sometimes in the R&D process. So I give the example of, let's say that you've got a salesperson. The salesperson, you'll say, well, they're in sales, they're not really in R&D. But oftentimes the salesperson is out there front facing with the client, and the client is saying, hey, this feature doesn't work, or I need this feature. And so they're either helping in the testing or they're bringing back the research and development issue to the developers. So in that situation, we'd want to carve out a part of that salesperson's salary and put it in the R&D bucket. I've even seen where we've had the CFO or the accountant, say, well, the accountant or the bookkeeper is not really involved. Well, a lot of times, again, in the startup business, they're involved somehow in contacting, doing surveys, or helping in the testing mechanism. So that's what's key, is to really make sure you're taking full advantage of those R&D. One also thing to keep in mind, the difference between the federal R&D and the Georgia R&D. A few years ago, Congress, let me go to the Georgia R&D first. Georgia, the reason the R&D has become so popular in Georgia, because Georgia was one of the first states to allow you to take the R&D tax credit against the payroll tax, the state withholding tax that you withhold out of your employee's salary. And so the problem is, most startup companies, they weren't paying income tax because they're in startup mode. They're spending those costs to build their product. And so what Georgia did is that, okay, if you don't pay income tax, then we're going to let you offset it against payroll tax. And it has been extremely successful. And it varies depending upon it, but the average probably is around 5% of for Georgia is about 5% of your labor spend, or any equipment that's used in the process of R&D. So Georgia had that first, and has been very successful for many years. Federal government found out about how successful that Georgia was doing, and said, well, you know what, let's do the same concept. So a few years ago, they passed and said that if you're a startup company, meaning less than 5 years old, and you have gross revenue of less than 5 million, then you can do the same thing. You can make this payroll election and use it against the FICA tax again. So just want to make sure that you are looking at that. I will say that it is a very specialized areas, and a lot of CPAs don't have that knowledge. We have a large group, and we do the R&D credit for a lot of other CPAs, either behind the scene or just as an add-on. So again, important two things: make sure you're taking advantage of it, and then the other thing is make sure you're thinking outside the box and not just including the developers, include anyone either. And you can take that as if they're independent contractors as well, so they don't have to be on payroll. The only limit is if you use an independent contractor to help in the R&D aspect, it's limited to 65% of what you pay. So something to think about there. One other thing, I'm sorry.
Quick follow-up on that. So the independent contractors, do they need to be based in the US, or are foreign independent contractors?
Very good point. The contractor does need to be, and the employees need to be in the US to take advantage of that credit.
Located in the US.
That's correct. That's correct.
Mm-hmm.
One other, while we're talking about jobs credit, is, or I'll tell you that what's sort of related to that is where Georgia has been very, very popular with startup companies, is they have what's called an opportunity zone. And if you create jobs or add jobs in these opportunity zones, then you get a $3,500 credit per employee for 5 years, and you only need 2 employees. So as you're looking for space, or you want to potentially move, I'd really highly recommend this. The opportunity zone, though, is really unique, and it's been very political. So certain areas have been able to carve out their county or their city to be in the opportunity zone. So I give, for example, Georgia Tech. On the Georgia Tech side of Spring Street, that is in an opportunity zone. But on the other side of the street, it is not in an opportunity zone. So that's one thing, the Georgia Tech program, the ATDC, technology center it is. And so is there a way for you to think about getting a location or having an office address? And how aggressive do you want to be? But is there that possibility? I know even though we're working remotely, is it still possible for you to get an office in that opportunity zone area? And you'd be really surprised of where those are. Downtown Marietta is an opportunity zone. There's some great ones along Jimmy Carter up in the Satellite Boulevard area. So we have a software. If you want to send us that address, we can plug it in and it'll tell us if that census block is actually in the opportunity zone. Again, it's not by zip code. It literally is a block by block throughout the state.
So, and you need the specific address where you're looking at, right, to run in our software?
That's correct. That's correct. Because it can tell if that census block is in the opportunity zone.
Interesting. Very interesting. So David, I know as part of the PPP loan and the SBA loan, Main Street Lending, as we are working with companies, helping them out with some guidance on that, we developed a 13-week cash flow projection, I guess, forecast model or something, right? Honestly, I have not really had a chance to deep dive into it. It looks a pretty good Excel file. Is that something you can, maybe share and, it's just kind of walk through at a high level? Maybe, some of the attendees may want to use that model to forecast out next 13 weeks.
Definitely. I'll do a quick share screen here. Now, the TIE team, you might need to allow me to share my screen. But at a very high level, you can think of these models as being something to the tune of, A plus B minus C equals D. And what I mean by that is the very simplistic model that we created for some of our much smaller accounts basically say, what is my beginning cash balance? What are my cash receipts coming in? Depending on how you look at revenue, if it's an accrual versus cash basis, any change in accounts receivable or customer deposits, but it really gets down to what cash am I going to get in a given week? And then what cash is going to go out? Things like cost of sales or payroll or facility costs, depending what type of business we're talking about, changes in inventory, changes in customer deposits. Either way, it's what is going to go out in that week, and you get to an ending cash balance. I think we've somewhat seen that the devil's in the details, as you hear Charles talk about the tax ramifications some of the tax areas that you can take advantage of and the ramifications of that, keeping track of some of these payments, making certain that if you're deferring payroll taxes, it's not, after forgiveness and things like that. So you could think of this model could be as simple as starting with cash, what comes in, what goes out, what is ending. You put it over 13 weeks and you at least have a view of where you think you're going to go. One of the reasons we really like something like this, and we think that it really could be a little bit more robust, you can see in this simple model that we created that somewhere between week 11 and 12, we're going to run out of cash here. And basically, do you need to draw down your debt? In this example, we like to make the model at least robust enough to say, if I draw down my debt in a line of credit of 500,000, you can see that we're going to pay more interest, right? Every action has an equal and opposite type of reaction of sorts, right? So you need to make certain that you account for things like that, even in my mind, a simple form model such as what we're showing here. Believe it or not, when you start getting to probably about 10 to 15 million of revenue, and probably even below that, it's just that seems to be the break point now with some of our clients, where we're really diving into what I'm going to call a 13-week 3-statement model. And at a high level, that takes what we're looking at here, but just puts it into an income statement with balance sheet and cash flow statement format. A lot of these clients, whether they're full accrual, they probably have aspects of partial accrual flowing through their income statements. They probably have some type of controllership team. They're probably on an accounting software like a QuickBooks or NetSuite, and they're using it in a much more sophisticated manner than some of the other smaller clients that we deal with. And this just gives them a greater level of insight. It also somewhat ties back, especially in a NetSuite or some of the more sophisticated, almost ERP type systems, to some of the dashboards that you could see and create within that. And so we like to go to this type of model sooner rather than later because of all the nuance and details. You could see in a simple form model, while it took care of our drawdown on our line of credit and the additional interest expense there, just knowing what is available in our line of credit. We sometimes put that down here in terms of line of credit used and availability, so you can track that. But if you just think of things like AR balances or inventory or AP, you're not really getting the full picture of how things may be growing or not growing. You can see partly the reason for this decrease in cash balance was we had a big increase in sales in this forecast, but we also had a customer that wasn't going to pay timely. And so working through those nuances usually involves creating a little bit more sophisticated of a model, whether you go all the way to a 3 statement or you at least track some of the key items that somewhat is a company by company specific example and need. Even in the 3 statement model, you see this tab I cut, supporting schedules, $15 million revenue business. I'd have to look back at their steady state EBITDA, but let's just make it up that they're about 20% margins. And the supporting schedules were really numerous in terms of going all the way from revenue to cost of goods sold, to working through what a true bill of materials looks like, to working through what our inventory and production schedule is going to look like, because like I mentioned before, not all sales are created equal. This was a specific account that revenue down quite a bit, but the majority of the revenue that was going to stay would be made up of 2 product offerings. And what they had to make certain was, if those product offerings did make up that majority of revenue, it kind of meant an uptick in those sales. Would they have enough inventory? If they don't have enough inventory, what do they need to do about production? Oh, by the way, this is the beginning of COVID-19 and everyone's very uncertain about supply chains. Do we have enough components on hand to manufacture, really assemble those units? And if we don't, what do we need to do to start thinking about ordering those components? Now, when you think about that in your mind, really the accounts payable and somewhat the upfront inventory costs could become rather large in their first 6 weeks to make certain that they fulfill revenue in, let's call it, the back 7 weeks. Whether it happens or not, we all know all forecasts are inherently going to be wrong by their nature, but these type of conversations really spurred the C-suite to say, we need to be thinking about that. We need to be cognizant it can happen. We need to be ready to execute on that type of business plan and make certain, as an example, now that PPP is available, we're bringing back the production team that we had furloughed. But oh, by the way, if it runs out, and when it runs out, do we let them go? Do we not? This really had some great conversations around that. It also had very good conversations around, they've said, to increase sales, should we just discount every product 20%? And we challenged them with an idea, which was certain accessories sell very well. Those accessories have lower margins. Why don't we give away some of the accessories? It seemed to us that they could give away $1,000 of accessories as opposed to giving a $2,000 discount on a product and potentially have a similar ramification to sales. I don't know if we would have had those discussions if we didn't build out all the supporting details on the bill of materials, understand the true margin per product, per accessory, and understand what accessory sells with what product. Some of which the company knew, but not all of which did they have those conversations up front. So you can see these conversations can go in a lot of different directions, and drilling in the details, while not always needed, I think often gives you really good conversations and items to think through.
Yeah, I think, one of the things, again, speaking from an audit side, like when we are looking at clients, auditing them, one of the things we closely look at is subsequent events, like how do future events impact your current state of business, right? If the company is looking for some sort of M&A transaction, how is the valuation going to be impacted based on future events that you may not be able to predict? And
Correct.
one thing, frankly speaking, I don't see a whole lot of companies spending quality time on quality budgeting and forecasting. I mean,
Correct.
obviously, there's so much you can do in terms of predicting the future. I mean, I wish all of us could do that, but
Right.
it's the fact that you still have to justify this is what our pipeline looks like, this is our forecast based on actual predicted events, and then constantly update that. I mean, it's an accounting nightmare, but it is a need. I
Yeah.
think it's very helpful to have that constant update to what your projected cash flow would look like and what's your balance sheet.
Yeah, there's a lot of conversations out there on how robust can you get with modeling. Do you layer in risk neutral frameworks of things like optionality within it? Do you layer in Monte Carlo simulation? Some of this is easier to do than ever before, but do you have all the great data to support it? We haven't gone quite that far with a lot of clients and conversations, but I think it does, to your point on robust budgeting, it's not necessarily always about the financial outcome, but the good conversations that type of discussion spurs. So if we're talking with a lot of technology-centric individuals, what are we doing about subscription-based payments? Or do we get the payments up front on a monthly basis, quarterly, yearly? How do we think about that cash? That is very lumpy in terms of what you're doing. That doesn't even hit some of the 13-week models. And so making certain that you think through different items, we've seen it also with some of our, where we source a lot of our data in our transaction group. A lot of those, they'd like payments up front. We've pushed those to twice a year. And now we're going quarterly because they said we're allowing that for all customers, no questions asked. That's rather nice for us, but all these different ramifications, I don't know if we would have thought through every single one of them if we didn't look through all the subscriptions that we have out there.
Yeah, sometimes when you start quantifying things, that's when, things take out, oh, I didn't think about this. And, something else is affected now that you put a number to some sort of business logic.
Correct.
I know we have less than 5 minutes. Charles, one last question, and then I think we'll open up for any other Q&A. Any last piece of advice to attendees on, like you spoke about all these tax breaks and tax reliefs that's there, right? Which ones will give the largest reduction in tax, right? Like what is it that companies need to absolutely not miss outside of the R&D tax credit?
I think the biggest part and where most of the government loss is projected to be was on the net operating loss carryback, not for both, mainly for 2020, expecting that you want to be, that's where if companies do take a hit in 2020, they'll be ready to go back. And I go back also just do some overall tax planning. Is it, since we can get fully depreciated, we can take 100% of depreciation for new assets. So with interest rates low, could we go out and buy some new new computers, finance in this low rate, almost 0% in some situations, and we pay it off over 2 or 3 years, but we get the immediate write-off on tax depreciation. So that's some of the things we want to consider, taking into account both the business economic aspect as well as the tax impact.
Okay, interesting. Okay, any last questions? I think we addressed pretty much what came our way, and we are cutting really close on time.
Yep. Jagruti, David, Charles, great work. I think very informative session. I'm glad this was recorded because I think this will be a good download for folks to hear. I think as they either contemplate more questions or would like to get connected on, elemental pieces that you guys can definitely provide some help with. So with that, I think you guys did a great job with answering the questions that came through. We're going to go ahead and end the webinar. We'll stay on for 2 more minutes if anyone has any questions that they would like to ask. And because we have some time left over, if you guys want to ask your questions live, please raise your hand in the attendee room and we'll bring you on to ask your question live. So I'll go ahead and wait for that for a minute. But aside from that, we will share this recording as mentioned on our website, on our YouTube page, and then we'll also be sending a follow-up so that you guys can get connected to Jagruti. I'm hoping everyone's connected to you already, but for Charles and David, hopefully you guys will be able to get connected as well. Looks like there was no hands, but But again, thank you guys. We'll be sending a follow-up via email, and we look forward to the next session with Aprio. Thanks, guys.
Have a
I
good
mean,
day.
one
Thank you.
second. Paul has a question. So
Oh,
I think
okay.
Charles, how far back can we go on the AMT refunds?
It's anytime you've ever paid AMT. So, and again, I think even in our own, it's where it gets missed when you change CPAs, and that carry forward, CPAs didn't really carry about that AMT before because it wasn't refundable in most situations. And so they didn't really do a lot of extra work to put it in the software and carry it forward. So if you had it 20 years ago and you paid AMT, then you can get it back.
And how hard is the application process? Is it a
If you do,
nightmare? Worth it?
it's very easy to do. And there's a special accelerated form. Again, that one has to be filed by June 30th, but it can get that AMT back.
Okay, great. All right, I mean, I think.
All right. I'm going to go ahead and stop the recording.